Today's episode of Market Talk is brought to you by Growmark FS. Keeping up on the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. Well, as we take a look at the market trade on Wednesday, another rough day in the grain and oilseed sector. Hogs finished lower. Cattle had a nice up day, so I guess what bright spot there. Crude oil under pressure. There is plenty of things to discuss in this market, and I'm glad we get to do it today with our good friend Mike Zuzolo, Global Commodity Analytics, joining us here on Market Talk. Mike, Happy New Year to you, sir. I hope you're doing well.
You too, Jesse. Thank you for having me back.
I appreciate the time as always. And, you and I were chatting just before we jumped on the air here. I wish the markets were higher. It'd be a little bit of more of maybe an upbeat mood here on the show today, but we'll do our best. Just looking at this grain and oilseed market, more pressure there on Wednesday. This has been a rough start to the trading year here in 2023, Mike.
Yeah, and it kind of feels like to me that the commodity index funds, those groups of people that were willing buyers of commodities at the end of last year on the news that China was reversing its COVID policy, are the same group of people or investors jumping back out now because China's COVID policy is opening up the reality that they've got a really big problem on their hands with the disease, and that the government, even the World Health Organization, now acknowledging this today, as a matter of fact, the government of China not giving us accurate numbers for how many deaths there are. And international health experts are saying we could be 1 million plus deaths in early part of 2023 as a result of the government policy. And it's interesting because for me, you can look at crude oil, you can look at natural gas, you can look at corn and wheat, you can look at copper, you can look at coffee. And Jesse, all of these are, if not making multi-week lows, making multi-month lows again. And these were the leaders to the upside as we went home for the celebration of Christmas and New Year's. And that's why I think it may be the same group of people. But it smells as though it's that shallow trade mindset returning, where global demand far outweighs what the tightness of supply says in the marketplace. And it isn't surprising to me, I guess, with the January 12th crop report right around the corner, that the trade starts to think more about and trade more of the global demand side of the equation versus the supply. And that, I think, is backed up in what commodities are going higher. As you say, the cattle market, soybeans, the meat complex as a whole. These are the markets that have the demand underneath them. Even gold hitting a 6-month high this month. And as we came back from the holiday, this again smells of stronger demand, and they don't worry as much about the supply side because the demand's underneath them.
Well, you mentioned that crop report coming up, and we're going to touch on that in a second. You sent me a couple charts, though, today, the Deutsche Bank index, the agricultural monthly commodity index. I'm going to pull that up on the video screen. I think this will tie in well to where you just left off. What are you seeing on this Deutsche Bank chart, and what are your thoughts here a little bit more on this global picture right now, Mike?
Yeah, I think this chart looks a lot like a lot of the ag index and overall broad commodity index charts that I keep track of. And I keep track of about 8 or 9. But this one shows a very strong channel to the upside that developed in 2020 after that long slide to the downside. We lost that channel support, though, in mid-2022 and essentially have gone sideways out of that channel and developed what now looks to be a wedge. And that's what you see in the green lines, the green resistance and the support lines, both forming a point and forming a pennant or triangle or wedge formation. And what this chart says to me, and this is real important, what I was just talking about, Jesse, you could make the argument that why didn't you know that the Chinese COVID policy was going to create such big problems when it came to the health of the Chinese people and the slowdown in the government of China because of their policy. Well, we did. You and I have talked about it for the better part of 4 or 5 months. Well, this chart shows that we lost a lot of price premium. We took out a lot of premium in this market and have gone sideways and haven't been able to register a strong move up because of the Federal Reserve policy and because of the Chinese COVID policy. So I would say if I didn't care about what the price action was doing this week, I would say that you don't need to go any lower at this point when it comes to the commodities because you've already priced a lot of the negative Chinese news already into this marketplace. But that's where the charts become extra important. That's where this wedge point, this triangle point, becomes very, very important because we're on our second month after having put that point out there. This market looks like it's getting ready to break one way or the other. And if you didn't care anything about fundamentals and you looked only at this chart, my opinion would be that the bottom lines, the purple and green lines that run together, those are very low in percentage points, which you would call oversold, which would suggest pretty strongly typically there's a lot fewer new sellers out there and a lot more new buyers waiting on the sidelines. And so if I didn't care about the fundamentals and the January 12th crop report, I would think this ag commodity index wants to try and go higher out of this wedge.
Well, let's think about if we do care about that January 12th crop report, Mike, as that is right around the corner. And I know I've been watching a lot of these numbers from USDA, including what they say on the U.S. side. What do they do with South America? And I know you sent me over some South American production estimates as well. And I just wonder, with this January report coming up, Mike, you know, USDA has given us so many surprises in the last 12 months or so. Can they do it? Can they do it again? Will they do it again? I think it's hard to necessarily really forecast this January report because it's a big report and it feels very unknown, at least to me it does anyway, Mike.
No, you're picking up exactly how everybody feels in the trade right now, Jesse, in part because of the yield changes that we saw so early by USDA here in the United States. And then you throw on top of that the South American weather. And then you throw on top of that the still uncertain grain shipping corridor coming out of the Ukraine and Russia Baltic area. And so there are several features in this trade report that are going to have to be looked at very, very carefully. But what this chart or this table shows me is that the trade has been a lot about Argentina weather, specifically Argentine meal, and the meal price leading the beans higher ever since December. And what you see in this table is that Argentina's soybean production is next to nothing in terms of importance to the overall South American production. It's really the Argentine corn production, because if you take 50 million tons of Argentine corn production into 172 total, and I'm using the Global.com research numbers, but even if you did the corn for the USDA, 55 into 181, you're talking about that corn makes up about 44% of the South American production, whereas in the beans, a 49.5 million metric ton production number out of Argentina compared to 211.5 total. That's only 23% of the total South American production. So you got to wonder, and you got to ask yourself, why isn't the corn going higher in terms of the Argentine weather? Well, that's easy to answer. It's because Brazil keeps outstripping us with China exports. But the bigger point is, how can the soybeans keep going higher if the corn and wheat are going lower? And I think, again, like mid-October, I don't think they will. And if you go back to your question about the January 12th report, I think the onus is on the soy complex to feed the bull to allow these prices to stay this high and this elevated, especially with the January meal, which is $20 premium to the March, getting ready to go off the board right around the same time as that report comes out.
And that was going to be my next question. You know, over the holiday period, soybeans broke that $15 mark, that psychological resistance, quote unquote, overhead. And we held up there for a couple of sessions. And then now coming back here this week, we've come back below it. And I just wonder if we could feed the bull with that January report or some other news item, can soybeans move back above $15 with support from, say, again, the meal market there, Mike? I wonder if it's possible.
they can with the help of the meal and the wheat and corn. I think it has to be all three. And I say that because the crop conditions for the hard red wheat, the damage done in Argentina already in the wheat crop. I know people say that's already priced in, but again, we've taken a lot of premium out of the wheat at this point. So I think you got to have almost everything running on all eights and it being supported and underneath this market. And I would add to that, last week, while I was wanting to buy into the corn and making the recommendation to buy back some corn, I also sent out a text blast to let some more 22 beans go, because again, it was nice to see all of them working together, but they weren't working together like they should. And so it was kind of a precursor to what we were going to deal with this week. And then yesterday, when we saw that the Chinese, in a Bloomberg article, it said bodies are stacking up at crematoriums around China. That's the kind of news story you see if you're in the commodity markets and say, what am I doing being long here? And I think it gets as simple as that at this point. And I think, why wouldn't you be getting out of your long bean positions if China's not buying as much from Brazil and they've got to go through this horrible COVID mess where you're not going to have crushing facilities operating, port workers to unload ships, so on and so forth, kind of what we talked about back in 2020.
Mike Zuzolo, Global Commodity Analytics, is our guest here today. Mike, staying on the grains a little bit more here, I'm hearing some whispers of some increased farmer selling, and that doesn't surprise me with the calendar flipping to 2023. Whether we're talking corn, I know cash basis has come down the last couple of days, soybeans, whatever the case may be. That doesn't surprise me. That psychological, okay, new tax year, I need to make some sales, cash flow, etc. Have you heard some of those whispers as well? Maybe a little more increased farmers selling on the recent rally here in the grains?
Yeah, I talked to a client in Owensboro, Kentucky today, and he said it was very busy at the elevator on the Ohio River there with a lot of trucks, and he was in line. Out here in this part of the country, a lot of trucks been running the last week. You see that in the basis also. You've seen some basis widening, some basis weakening in both corn and beans as you get west of the Mississippi River. And I think you're right, Jesse. I think the producers know that, as you said, you get above $15 in November beans. That's a price you typically don't get very often. Why not let something go for cash flow? And when I talked to producers this week, even though I had been re-owning corn, I made it very clear we don't want to go below 665. We don't want to go below the 10-week moving average, especially after having 2 weeks in a row higher going into the first of the year. So technically speaking, these are tripwires that I think you do let some corn go, especially if you had corn on basis contracts at a higher basis level.
The wheat market as well. I know you brought up the Black Sea region. I know we're hearing reports that Ukrainian officials think Russia's going to mount a new offensive, possibly. I'm seeing reports that insurers aren't wanting to insure ships out of the Black Sea corridor now. That's getting harder and harder to do. This wheat market trade, though, feels a little thin to me. Are you seeing anything chart-wise or anything else in this wheat market overall that you're watching right now, Mike?
Yeah, Europe is still the leader right now, and it's the leader fundamentally. The Black Sea market seems to have slowed down with the holiday, and we also had the funds liquidating their long position over in Paris wheat. Both of those things should be coming to a close, but I think, Jesse, you tap into something with the insurers not insuring in this new offensive. Why isn't that pushing premium back into the wheat? You see 19% good to excellent in Kansas wheat, and very poor to poor almost at the 50% mark, and still declining at this point because of no precip and temperatures that are going to be in the 40s for the next 14 days, drawing down reserve moisture. Why aren't we rallying? And I think it really does go back to that demand base and that psychology of U.S. wheat. And when I saw a 3 million bushel export inspection number yesterday, I thought, holy cow, where'd my demand low go? And I was really a hit mentally to have to see such a weak export inspection number, even though it was a holiday week, and the trade gives you a little bit for that. It was still below the lowest trade guess, and that really does matter each and every week.
Let's move over to livestock, Mike. You mentioned that export number. It was a rough week last week on the beef side, I believe. If I remember that number right, it wasn't very, very good at all. But yet, this cattle market, everyone's still fairly bullish. We had a good day Wednesday. Feeder cattle took advantage of the break in corn. What's your thoughts with cattle? Let's just start there. I'll leave it open-ended for you. What are you thinking right now?
Yeah, not a lot of changes since we last spoke. I wanted to let the bull run, but wanted to get Q1 hedges in place once I felt like the top was in. And the question mark is what's your best canary in the coal mine for the top? And I think it's the feeder cattle market. I talked to several producers, several ranchers from southern Illinois to northern Nebraska today and yesterday, and all of them are talking about popping the champagne bottle corks and getting out the champagne bottles and in the feeder cattle market because they just see this tighter supply coming in a real revved up market, and these cash prices are already showing it. So the answer to me is as long as the feeder cattle can continue to go higher, especially with the fat cattle carrying a big an extended premium against the feeder cattle right now, as long as that can continue, let the fat cattle go. April fat cattle could get up to that 164, 165 level. That's kind of where we were back in that 2014, 2015 area as far as ranges to the upside. That would be an area that I probably wouldn't want to let fall back below. But as long as the feeders keep going, I'm okay with the fat cattle running and trying to get another high set in place.
Well, I look at feeder cattle, August, September, October, November, those deferred contracts are sitting nicely above the $200 mark. Now, whether or not we hold that remains to be seen. That's a long ways off, but just interesting note there as well as you talk about just some of the excitement and exuberance in this feeder cattle market right now.
Yeah, and we are getting exuberant, and that's one of the first warning flags out there. And I think we finished out 2022 with beef production up about 1%. Pork production looks like it's going to come in down about 2.5% maybe, based upon the latest USDA figures. And we still don't have a real good handle on the holiday trade at this point. So I would say watch that exuberance. Take advantage of that exuberance by getting hedges in place once you see a little bit of weakness. And one of the big numbers I put out to producers this week was in the feeder cattle was not going below the December low of 180. So we're getting ready to see January go off the board, March take over as lead month. That's always an interesting time period because the March and May feeder cattle seem to always be a little bit wobbly and weaker than those prior months. So don't let 180 get taken out in feeders to the downside, because that really does take away, I think, a lot of horsepower for your cattle to keep going higher.
Hog market, and I love how you always frame up the pork and bean trade. I think it correlates together so well. And we saw as beans lost some momentum and some support on Wednesday, so did the lean hog market too. What's your thoughts there?
Yeah, you can tell and smell the managed money in the soybean and hog trade again, and that's going to make it a lot more volatile. And I think that's the word for 2023. And I don't say it's more volatile to scare people away from the markets. It's to get them to be more engaged in the markets so that they take advantage of prices when they get to the levels that exceed your expectations, or you don't carry a long position below a price level that exceeds your expectations because you aren't watching it. I think that's the key with the hogs. I like the hogs overall in 2023, Jesse, because I do think that the Chinese demand's going to come back eventually. And 4 to 5% growth once we get past this COVID problem, I think will help keep those exports very strong on a tight domestic supply. So maybe after the March hogs and pigs report, we'll have a better idea of where the low is in this hog market. But I do sense in the hogs overall, we'll put the lows in early in the year. But for the fat cattle, it really doesn't matter if it's early or late. I think it's going to be early, but I'm looking at a really significant possibility of a cycle high in prices for the fat cattle in 2023. So the hogs will play some role in that, I think, but the cycle numbers are really pointing to major lows about 6-7 years out, and we're running into a period where that cycle high could be right around the corner.
Well, Mike, before we wrap it up, I'll use a bad golf analogy, but it feels like, a couple days into the trade here for the new year, we're on tee box number 1, teeing it up and ready to take off here for the first round of trading. Any final thoughts, anything else on your mind, or you want to reiterate for listeners here before we wrap up the show today as we look at 2023 ahead of us?
Yeah, I got a quick look at the Federal Reserve minutes, and it doesn't look like they're going to give us much help as far as the outside markets and the dollar and the crude oil market, because it said very specifically they do not want to give a false impression of easing or coming off their rate hikes too quickly, because that would be a bad signal to send to the financial markets. So I think buckle up in the outside markets, and we really need to see some demand come back in for the grains in particular to kind of get us back into the supply demand markets and get out of the macro side of the equation.
Well, Mike, great stuff as always. And I know if folks want to reach out to you and take a look at your research and have a conversation, they can do that very easily. What's the best way to get a hold of you, Mike?
Globalcomresearch.com, globalcom with two M's, research.com, or give me a call toll free, 866-471-2588. Have had some people call to get some meetings set up. Please feel free to see if that doesn't work in your schedule, or if you have a specific question, give me a call.
Globalcomresearch.com again, as well as the place to get a hold of Mike Zuzolo with Global Commodity Analytics. Thanks so much for the time as always, sir. Enjoy the rest of your week. We'll talk to you again next week.
Let's hope we're 30 higher tomorrow, Jesse. Thank you, sir.
Hope so too. That's going to do it for Market Talk here today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.